and you look not just the last 20 years plus, but you look at the entire time that gold as an indicator has been free to trade against the dollar. The dollar since the American Revolution was defined as a certain amount of gold. It's not just a peg. The dollar was gold. It's not good as gold. It was gold. That was the definition. And that definition was changed most famously by FDR in the Great Depression, which was a 50% devaluation by any other name. And then Tricky Dick Nixon in August of 1971 completely severed gold from the dollar. I like to see that, the negative view is that there was ultimate dollar debasement. It was a betrayal. It was, the dollar was supposed to be good as gold, and now there wasn't even a theoretical connection between gold and the dollar. And by the way, it was a temporary suspension due to that emergency by those evil speculators that were whacking the dollar. But the point is that since then, we had price discovery. Instead of gold and the dollar being defined and set by law at a certain rate, gold was freed from the dead weight of the dollar to trade, 1971. So we're looking at 70 plus years, 75 years now, happy anniversary. And it's a giant letter X. That chart, if you look at the purchasing power of the dollar versus gold, or the gold dollar exchange rate, as I like to call it, it's a giant, slightly curvy letter X. That's really all you need to know in certain ways. I mean, basically what this chart is telling you, what gold is telling you, is what we all know about fiat currencies, especially if you've had crypto training, right? You understand the dangers of fiat currencies. It's an abstraction. There's no actual value there. The governments can print all they want. And that's what that chart is telling you. It's telling you that, gold goes up this year, goes down this year, has a massive correction, like Bitcoin between halvings or whatever, like whatever the volatility might be, even if it's lasts longer than one is comfortable with, you pull back and you look at that big picture that you asked about. It is a giant, incontrovertible X. Purchasing power of the dollar down, gold goes up. I'm not sure if this is going to be inverted on Zoom or whatever, so I'm not sure if I'm pointing my arms in the right direction, but I think the audience understands what I'm saying. So that is, to me, it's absolutely unquestionable. This is the financial reality of the world ever since the financial system globally was severed from anything real. Gold is one aspect of something that is real. You can hold it in your hand, but it doesn't matter. The point is that the ultimate fraud that fiat is being exposed. Therefore, whatever the volatility, I think gold goes up as long as this experiment lasts, until maybe there's a new gold-backed currency or something. I have a hard time valuing the cryptos, but the same logic applies there. But it also applies to any real assets, anything of value that governments can't print. So if we talked 2 years ago, I probably would have been talking copper. And here we are with copper having hit fresh all-time highs. Real estate, there's an affordability crisis because housing has gone up so much. Well, it's not really, in my view, that the housing or even gold has gone up that much. It's that the dollar has gone down that much. That, I think, for the patient and for the discipline, is such a solid, durable trend. Like people say, well, how high can gold go? How, when does it end? And my answer is to question them, well, how low can the dollar go? When will governments stop printing? And I see this as a highly investable, highly durable trend that if you can, bet right and sit tight, you can make a lot of money on. Timing the fluctuations is a lot harder, of course. But there's reality there. And I know that it has worked for me and my clients.
There's a trap built into conviction itself. The strategist warns that hard money investors often drift from reasonable skepticism of government into full-blown doom prediction, convinced the whole system has to collapse any day now. History offers a caution here. People were sounding alarms about runaway debt back in the 1970s too, when the national debt was a fraction of today's nearly $40 trillion, and the system didn't collapse. It kept absorbing shock after shock, including 2008. The lesson isn't that the risks aren't real, it's that being early by years or even decades carries a genuine cost. Missed opportunities spent waiting for an ending that keeps getting pushed back.
People who generally understand what I just said, they tend to be skeptical of government. If they're not outright libertarians, they're conservative, hard money advocates, or even old-style Democrats who don't believe in tax and spend. Like that was not a democratic thing in the past. believe it or not. Talking a century ago. But anyway, so like if you get it, there's this tendency to be pretty questioning, if not hostile, to the state intervention in the economy and the minions of the state. Whether it's Powell or Warsh or Yellen or whoever, it doesn't matter. They shouldn't be interfering. We question everything they do. We push back, and we think they're wrong. They're making mistakes, not just a policy mistake. Should it have been a rate hike yesterday, whatever, but just that they're interfering at all with interest rates is a mistake. They, abolish the Fed, right? So if you're in that kind of mindset, it's very easy to say, oh, well, here's the smoking gun. Here's the disaster. Markets are going to crash tomorrow or next week, and the whole house of cards is going to come collapsing down. The problem with that is, okay, I was just a kid in 1971 when gold was severed from the dollar. But I remember, and I participated. I was the proverbial shoeshine boy collecting silver dollars. Okay, I mowed lawns and I babysat, but I turned my money from that job, that work, into silver dollars because I got it. I understood. There's a whole story for that too. Why? But anyway, so I participated in that. And I remember, everybody was talking about the national debt. Are you kidding? The national debt of the 1970s, now that we're pushing $40 trillion, we'd love to have that national debt now if we could. But what I'm saying is that, there were plenty of people back then talking about the sky is falling and you need to be ready. So if you hunkered down in your bunker in 1979, thinking the world was going to end, you could be like that Japanese soldier who never surrendered after World War II, and he kept fighting for 29 years and didn't. They had to fly his commanding officer from Japan because he didn't believe all the leaflets and the propaganda was all lies. So they found his old commanding officer, flew him to the jungle in Philippines or whatever it was in 1974, and the guy ordered him to surrender, and he finally stopped fighting. So can you imagine if you had hunkered down in your bunker in 1979 and you're just, waiting for the world to end? Let's just say that if the house of cards finally does come collapsing down soonish, the opportunity cost for having got that wrong for decades is huge. Like even if you're right in the end, all the times that you didn't invest or didn't participate or didn't enjoy life during, waiting for that disaster, the opportunity cost is huge. So I think this is actually a really important takeaway because as I framed my answer, there's so many of us, my fellow gold bugs and people of like mind, that are prone to see the worst in the mainstream, in the status quo. And we tend to be disaster oriented. We think, the house of cards is a house of cards. Of course, it's got to collapse. But as our friend Rick Rule likes to say, never confuse the inevitable with the imminent. And, from my experience, my riff on that is I don't want to hear about inevitable or even imminent. I want to know what's happening now. Because it just, you think and even you're right. That inevitable has a way of getting kicked down the road so much, so long. Even the smartest people that you've interviewed show, my mentors, the people that I looked up to, and in 2008, 2009, I don't know anybody who thought the government could just paper that over. And yet here we are decades later, and they did. So beware of some compelling macro thesis that eventually may even be right, but may not help you make good decisions today for your life right now. I think that's important.
Instead of betting on some grand macro endgame, this approach favors reading present conditions as they actually unfold. When the Israel-Iran conflict escalated and a Strait of Hormuz closure looked imminent, forecasters were calling for $200 plus oil. Instead, prices spiked toward $120 before settling back under $100. The takeaway? Even textbook worst-case scenarios rarely play out as cleanly as predicted, and betting everything on one single outcome is risky. The more durable read, according to this strategist, is that the region remains locked in stalemate. Neither full withdrawal nor decisive victory looks likely, and that ongoing uncertainty is exactly what creates mispricings worth investing in within energy markets.
Could spend days just talking about the different things, but let me give you a concrete example. When this latest stage of the conflict in the Middle East heated up in February 28, oil spikes. And the sort of nightmare scenario that everybody knew or talked about or planned for, war gamed, all that stuff modeled out, would be a closure of the Strait of Hormuz. And so when that looked like it was going to happen, you had all the experts talking about $200 oil, $300 oil. I mean, this was it. This was the big kahuna, right? Closure of the Strait of Hormuz. It's going to change everything and end the world as we know it. And somehow there was a little spike up to 120, and then it pulls back to under $100. And okay, I'm not saying that it's no big deal or nothing's happened. I'm not saying that. But if you had seen this is happening now, right? This theory has gone from inevitable to imminent. This is happening now, and therefore I know what to do, right? Go massively long oil. You could have had your behind handed to you by being overly confident in that. So the first thing is that just because you see what's happening now, have some humility about what it means. Sure, take a bet. If you think you've got it right. But don't bet the farm. Don't go all in. I don't think I've ever gone all in on any thesis. But beware. But so, that having been said, the cautionary note having been said, like right now, it's pretty clear that, and Trump fans don't want to hear this, but I think we got to face the facts. A quagmire by any other name is just as sticky, right? It sure seems like, it sure seems hard to see a path forward or out from the conflict in the Middle East and the Persian Gulf that doesn't, what to even say. If Trump just says, okay, we don't need the oil anyway, and walks away, that leaves this huge mess. You countries that you need the oil, well, you fix it. That the consequences of that, I think, are pretty big, even back home in the United States. But if we stay, like if he says, I'm going to finish the job, it's pretty clear that, more $1 million missiles pounding sand over there isn't going to cause the regime to capitulate. And there hasn't been regime change. You want regime change? I'm not even sure boots on the ground could do it. But if you were going to do it, I think it would take that level of commitment, which seems just as unlikely. So a what's happening now point that I'm making is I'm not saying I know what's going to happen. I'm saying I know that, the experts have been wrong. And that's something that's happening now. And that's worth thinking about. And if nothing else, the most probable course going forward is that, it's a quagmire. We're stuck here. Therefore, the futures market that seems to think the war will end and the oil will go back down, that's a mistake. If that's right, if quagmire is where we're at, then the market is making a mistake, and that is investable. That would be one example. Another thing, just what's happening right now, as you and I record, we just had, Kevin Warsh deliver his second talk, which even the talking heads on mainstream media, which usually they're pretty polite, they might push back with questions, but they, the mainstream types, they tend to be pretty polite. It was striking to me how much criticism there was of Warsh after that. I mean, even on Bloomberg, they were saying something like clear as mud, which was an unusually harsh judgment of that press conference. But so what's happening now is, despite the recent reprieve in inflation stats that we've had in the U.S. because oil did come down during the memorandum of misunderstanding, which is already done. Oil's already gone back up again. So there has been some reprieve on inflation data, but people are definitely, not taking that as something to celebrate because the reasons for that are already gone. So what's happening now is persistent high inflation well above the Fed's arbitrary 2% target. And despite that, and despite the bond markets, which the Fed and even Warsh commented on, they're well aware, despite the bond markets telling the Fed you need to raise rates, they didn't. They did nothing. I don't know if that made Trump happy. He wanted rate cuts. But where I'm going with this is it's pretty clear, like the data from the mainstream economist perspective, from the perspective of those hundreds of PhDs the Fed has working for them, they should have raised rates yesterday, and they didn't. So that tells me that the people who were saying, well, Warsh was appointed by Trump for a reason, I think they're right. The Fed did not do what it should have done. Yesterday was a policy error not from my libertarian perspective, but from the mainstream economics perspective. I think Jeff Gundlach, the bond king, has shown charts showing that, like, if the Fed's so-called symmetrical inflation, like they say 2%, but when it was over 2%, they were, oh, that's okay, because we want to average 2%, right? So if they want to average 2%, they need interest rates to be basically zero for the next 10 years to make up for the overshoot. So for the Fed to be sitting on its hand when it's at 3%, 3.5%, depending on the number you look, so-called core PCE is well above 3%. And that's not what the Fed wants. So they're not doing what they should be doing. So so this is telling us something that's happening right now is that the war skeptics, or the people that said he was a dove in hawk's clothing, I think we were just shown that they were right. And that has investable consequences as well.
New Fed Chair Kevin Walsh, who took office in May 2026, has drawn unusually sharp criticism, even from financial media that's typically more measured. Bloomberg described one of his press conferences as clear as mud. Walsh has pushed to scale back the Fed's public guidance and floated new ways of measuring inflation, even as core PCE inflation held near 3.3% through mid-2026. The July FOMC vote saw the most dissents in nearly a decade, and despite bond markets signaling rates should be rising, the Fed held steady, something skeptics read as confirmation that political pressure, not just economic data, is now shaping policy.
The ultimate answer here, and this has been my main theme harping on this year, and it sounds so silly almost, it's so basic, like, why do I need you to tell me this? Why do I need to pay you to hear this? But some things are easier said than done. And sometimes just because something everybody knows it doesn't mean everybody implements it or acts on it. And so the fundamental here, and this is maybe the single most important from a financial perspective answer to any question you'll ask me in this interview, is don't forget to buy low and sell high. Okay? Buy low, sell high is the whole idea. And I bought low years ago when we talked a couple years ago. Like anything that copper, I was hot on copper, but I was very long gold and silver. And I had bought years before. So when the metals pulled a hockey stick earlier this year, particularly gold and silver, I remembered the sell high part. You got to be willing to buy low, which is hard. Blood in the streets. Everybody's panicking. There's hate. Our friend Rick Rule likes to say, "I love hate. I buy hate, and I sell love." Right? That's the contrarian mentality. That's how you buy low. But you can't forget the sell high part. And here's to the what's happening now part of this answer. I did not top tick the market in January. I did tell audiences at the Vancouver conference in January, 2 days before the top earlier this year, that it was time to look at taking profits. And then we had the big retreat that triggered my technical system, as it were. I call it the upside maximizer. So my system gave me a sell signal, and I didn't just take profits. I sold all of my gold and silver stocks. It was such a big move, and I had such big unrealized gains that I just went ahead and booked the win. And people are like, "Oh, you trader, your gold's going higher. Don't you know it's going to $10,000 or whatever?" Maybe it would have. Maybe if I had done that and gold had kept going up, you know what? I'd still have the wins. Maybe I could have, would have, should have won more if I had held. Doesn't matter. I had the wins. I still have the wins. So for now, again, it doesn't help me to sell newsletters to sit on cash. People want a hot stock tip, but I am sitting on cash, and I feel absolutely no FOMO. I feel no hurry. For people like, "Oh, well, gold's going to go higher." Well, yeah, I think at some point it will, but that doesn't mean A, that it can't go lower first, and B, why do I have to buy now, today? Like, why are you so upset with me that I'm waiting? I'm not trying to time the market. I'm just waiting for the next opportunity to buy low. And guess what? If gold and silver take off tomorrow, then I sold all my stocks and they take off tomorrow, I'm not going to cry. There will be something else. And my main example for this year, in the context, again, what's happening now and referring to what we talked about earlier, is this war has been bad for gold. And if I'm right that it's a quagmire and it's going to be hard to get out of it, then what's the rush to buy gold? That war's been bad for gold. The war's not over. It looks like it's going to be difficult to get out anytime soon. That says at the very least, even if I'm bullish in this year or in the months ahead, I may well see lower entry points in the immediate future, the weeks ahead. So why do I have to buy today, right? There's people who get mad at me. You're missing the boat. Well, what if I agree with you? I want to be on that boat. But why do I have to get on today? It's still tied to the pier. Right? There's no signs that the smoke is not coming out of the smokestack. It's not, the whistle hasn't blown to say we're leaving the dock, right? So that ties into my answer, right? The whole idea is buy low, sell high. I don't know what's going to happen. I don't know if gold's going to take off without me, or I don't know if gold's going to plunge if the war continues and give me an opportunity to buy low. I know that if I sit on the cash until something gives me that chance to buy low, then I'll make more money, right? If I buy high and I'm lucky enough to sell higher, I can make money. But if I buy low and sell high, I'll make more money. So why? That's the logic. There's no reason to rush to deploy now. And it doesn't make me a bear, by the way. Just to say that it might go lower is not saying I expect it to go lower. I don't know which way it'll go. I'm just saying I'd rather buy low. And guess what? If this ship does sail, I'm wrong. It was nuclear powered and I didn't see smoke from the smokestack because there was no smoke, right? It just took off. There will be something else. And again, another right now happening thing is this war. It's been bad for gold. There's been a strong inverse relationship between the oil price and the copper price during this war. It looks like a Rorschach blot vertically, right? Oil up, copper down. Not every day, not every wiggle, but overall, it's a strongly inverse relationship. And anybody, you can check me on this. Look at the charts. There are charts in my free weekly letter. But where I'm going with this is, so if I'm right about the war continuing and that pushing oil higher, then it should create better buying opportunities in copper and other things happening in the broader economy. Let's say the AI trade unwinding, which is also happening now. I didn't mention that, but it's one of those trends. There's a big scare in the whole AI sector and where's the return on my investment for all this data center spend, all that stuff. That has been a tailwind for copper recently. So if that unwinds at the same time that the war heats up, we could actually see objective buy low opportunities in the copper space. Or let's say I'm wrong and it goes completely the other way. Trump and the new Ayatollah kiss and make up and become BFFs forever, right? And oil just tanks. Well, in that environment, copper probably takes off. It's Dr. Copper, and yay, we're going to need more of it. But if oil tanks, we're still stuck with all the things that have been blown up in the Middle East, mines in the Strait. I think that becomes a buying opportunity. So if gold gets away from me, maybe oil goes on sale. If oil gets away from me, maybe copper goes on sale. Uranium has also become a picks and shovel play for the AI story. I think that's wrong. The fundamentals are extremely bullish for uranium, even before the AI hype. But to the degree that the market has identified it as another AI thing, it could get oversold. Like more than a year ago now, but last year, when that DeepSeek moment happened, uranium stocks went from 52-week highs to 52-week lows on that scare. Completely wrong-headed, and it reversed within weeks or months. Some of them went to all-time highs after that oversold. I would love for that to happen again. It would be an absolute gift from Mr. Market if uranium or copper, by the way, just went on the deep discount rack because of an AI scare. So, sorry, I've gone a bit long here, Ben, but my point is, have some humility. All these people, these gurus that get out there and tell you, I know what's going to happen, bet massively on this thing because it's guaranteed. The Fed's going to do this, the war is going to do that, copper's going to do this, AI is going to do that. If they're the hero and they bet right and they're right, yay. But they can't all be right. And they're all saying different things, right? And all the ones who bet massively and they're wrong, they lose money, and they lose money for the people who listen to them. So what I'm saying is somewhat different. I'm saying, I don't know. I have that humility. But I also have a pile of cash. So I'm willing to sit on that and wait for one of these things to show up. I don't know which one's going to be, but some of them are moving in opposite directions. So I'm highly confident that one of these opportunities will show up. And I know that if I wait to buy low, whichever one it is, I'll make more money than if I get impatient and, cash is burning a hole in my pocket. Oh, this one's relatively cheap. I'll buy that, right? that is a way that I could actually lose that money that I just worked so hard to make. Whereas if I wait, I'm patient, and I pounce when there's an opportunity to buy low, the odds are that I will add a zero to that pile of cash. That's my goal.